a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Bloomberg Quint Live. You're watching Trend Spotting. I am Shraddha Babla. Good morning, Arun.
Good morning, Shraddha. I am Agam Vakil, and in the next 30 minutes, we deep dive into specific trends in the markets to draw out key takeaways and their implications for investors. First, the headlines. Markets trade with healthy gains on the first trading day of FY19. Pharma and automakers lead the gains while banks weigh heavy. Mid caps in line with benchmarks, whereas small caps outperform. And the Nifty Auto Index jumps over 1% after automakers report steady sales for the month of March in comparison in the last financial year. And of course, ICICI Bank falls most in 7 months and also to its lowest level since August 10, 2017, as SEBI begins looking into matter for any possible disclosure and corporate governance related lapses. And it's a busy day at the National Company Law Tribunal with Binani Cement and SR Steel coming up for here.
All right, let's look at how the markets are faring at this hour. The Sensex has held its 150-point lead. The Nifty index is trading about 0.5% higher, with HDFC Twins and Reliance contributing nearly 60% of those gains themselves. The mid-cap and the small-cap indices outperforming, both of them trading with gains of over 1% each. Auto, pharma and capital goods are sectoral gainers, while banks are trading weaker, dragged lower by ICICI Bank on the back of that Chanda Kochhar Videocon fiasco. But market breadth overall remains favourable, with the advanced decline ratio at 4:1. But Agam, what are the key trends that stand out today?
Well, in key trends in today's job trade, we are certainly discussing Filatex India's expansion plans with Chairman and Managing Director Madhu Sudhan Bhageria. And we connect with the management of Sandhar Technologies after the stock lists at a premium on the bourses. And what's worrying the players in the power sector, as we ask Rupesh Sankhe of Reliance Securities, which we cover all that in the next 30 minutes.
All right. All right, and Agam, you were also telling me how some of the auto stocks are really doing today on the back of those monthly sales numbers that came out. So I think autos was one of the sectors that is faring pretty well today. Right.
Well, as you know, we've had some very good numbers coming in from Maruti Suzuki. In fact, we're looking at quite, a gain with respect to its volumes for the month of March. And well, the majority of its gains are coming in the utility vehicle space, and this is largely on the back of Brezza, which has had a very good month. Of course, its mini hatchback segment continues to do well for Maruti as well. Again, looking at robust numbers. When it comes to commercial vehicles, and in this case, I'm talking about Tata Motors. Well, we've seen very good numbers, especially from the light commercial vehicles, which is where the volumes have, as a matter of fact, doubled. Very strong, numbers and volumes coming in from something like your medium and heavy commercial vehicles. Let's not forget, we've seen a little bit of pickup in passenger vehicles as well for Tata Motors, and that's possibly the reason why we could see an improvement even as we move into the next few months. Of course, Royal Enfield is the other one which continues to be on track with robust growth coming in. So those are some of the few counters which are also doing well in today's day of trade, Shraddha.
All right, but let's talk about a sector which hasn't really been faring well of late. Too many concerns emerging on that sector, and we're talking about the power companies. Now, all components of the BSE Power Index, barring NTPC, have dipped with cuts of over 1% each to as much as 27% for Adani Power. And this is from the Power Finance Minister ordering a scrutiny of loans given by PFC and REC right across to issues of demand supply concerns that have popped up in this sector. Now, players in the power sector have been witnessing one hurdle after the other. So is there more pain in sight for the power sector companies? We will get an analyst view on this from Rupesh Sankhe, the research analyst at Reliance Securities, who joins us on the phone line. Good morning, Rupesh. Just wanted your thoughts and wanted to understand what are these concerns that are emerging with respect to the power sector. What are the fresh concerns? Because we already know about the DISCOM pain, about the coal shortage issues. Because recently you have a lot of bankers, even the likes of SBI, who have come out and spoken about being worried over some of the power sector exposures.
Yeah, good morning. As far as the FY 18 years is concerned, we have seen a lot of issues like a lower system demand. Then there was lack of long-term PPAs that was signed by the DISCOM. And coal supply was a slightly issue because of REX availability was low. But, and obviously we have seen FY 18, the companies have underperformed relative to market. But in FY 19, we are expecting some sort of recovery in terms of demand growth. We are expecting close to 7.5% kind of power demand growth. Secondly, there are a lot of initial signs of demand recovery is there since last quarter. So sizable recovery expecting because of industrial capex recovery. Then we have seen this government last mile connectivity program that will unleash some of the latent demand, and we expect some resumption of long-term PPAs once the SEBs would get successfully implemented. So FY 19 is expecting to be a better year for power companies, but still we believe that regulated players like NTPC, Power Grid, those companies will do better as some NPA issues are there with the private players.
Rupesh, I don't know if you're tracking the updates with respect to a possible merger or a possible combine of NTPC, REC and PFC. But if this were to come about, what would it mean for something like an NTPC, and what would it also mean something like an REC or PFC for that matter?
Yeah, this is a proposal, and now they will talk with the Minister of Finance and financial lenders. I think it's a good proposal because out of 40 gigawatt of the stress assets that was identified by Minister of Power, we believe that 25 to 30 gigawatt are still reviable assets. And the companies like NTPC or PFC, REC, they have financial muscles, and they can, because if you look at the past record of NTPC, they have made a lot of loss-making companies into profitable business. But it's a win-win situation for both power generation companies, financial lenders, and distressed asset. Slightly negative for NTPC because people were expecting that there will be growth for NTPC in terms of inorganic growth. But looking at all these assets, 40 gigawatt assets, though most of these assets are not under NTPC's buyout candidates, because clearly they have mentioned that we want plant with more than 500 megawatt capacity, and most of these plants has to be based on indigenous equipment. So most of this around 25 gigawatt is not under NTPC's takeover criteria. So we don't believe that NTPC will have very negative impact because of this. There are other assets of close to 15 gigawatt which are very much viable that NTPC can have a target.
Rupesh, I want to shift focus to the peak power demand, which is expected to rise given that there is a forecast for higher than average temperatures. Is there, and of course there have been concerns over the total coal inventory lying at certain power plants. Do you believe that there is adequate coal supply and some of these power plants will be able to meet that sort of peak power demand? And broadly, what are the steps you think that the government could take to resolve some of these power company issues, be it thermal power plants, solar, or even on the power distribution side?
See, if you look at the last 3-4 months, the coal supply to power plants has come down drastically, mainly because of REX availability issue. But now clearly there is a talk that the Power Ministry, Railway Ministry has set some the tracking system whereby they will track the ongoing status of coal inventory at power station, then coal supply. So a lot of initiatives are happening there, and Railway has ensured that they will supply close to 615 million tons in FY19, and availability of REX will be around 288 REX per day. So another initiative measures that they want to bring down their average loading time. That will also have impact on the coal supply. And some of the Coal India's mines, close to 21 mines have got environmental clearances, which will add close to 43 million tons in FY19. And 11 new coal blocks have also added. So the target which I have set up by Coal India is quite realistic, and because of this higher REX availability, we will see the higher coal supply to power companies. That is one factor. And secondly, that because of Uday implementation, a lot of distribution companies will sign PPA. And secondly, there is some recovery, industrial capex recovery is happening. That will also add to the demand growth. So overall, we are expecting that FY19 is going to be a good year for power companies in terms of demand growth.
Okay. But as far as the Mundra plant is concerned, Rupesh, the under recoveries continue. So where does that leave Adani Power and Tata Power?
See, for Tata Power, I think their coal and the renewable business are doing good. But still our hang is there as far as the Mundra is concerned, because under recovery is still close to 80 paisa per unit. And recently we have seen that the coal price is continuously moving up. It's now close to $100 for 6,300 calorific value. So that concern is there for Mundra. Now the option could be either to equity stake sale that they are talking with the beneficiaries. That can be a viable option and a trigger for Tata Power. As of now, Mundra overhang is still there, and that might cap upside from the current levels.
Rupesh, I was actually going through a few reports with respect to NTPC right now, and what we understand is that while the third quarter hasn't been fantastic, analysts across are willing to give it some leeway with respect to the possible implications. My point is that analysts so far are willing to remain at least slightly positive in the near term. I have some expectations of generation of return on equity for NTPC at around 14 to 15%. How are you viewing trade with respect to NTPC, and how are you viewing it from an investment horizon?
We are also positive on NTPC. Firstly, that in the next 3 years, we are expecting close to 17% kind of a CAGR growth in their regulated equity base, which is currently at 503 billion rupees. The why higher regulated equity growth is mainly because the capacity they are targeting to add in FY19 and 20 is close to 10 gigawatt capacity. Already capacity which have commissioned in the last year now is getting added in the gross block. That will add to their regulated equity. So what we have seen in the last 3-4 years of low earning growth, low regulated equity growth, that scenario will change completely in the next 3 years. Next 3 years, we are expecting higher growth in the return on equity. Earnings could be around 18% CAGR growth, and capacity addition as well as a strong balance sheet. And the valuation is at a historic low valuation. It's trading at just about 1.1 times price to book value and 11 times PE. It's reasonable. Strong upside is there from the current level. And we are expecting that target price could be around 213. So a decent upside from the current level at about 25%.
Okay, Rupesh. So just to sum it up, given the current situation, which companies do you think are the best place from an investment perspective? I just want your pecking order.
See, in the regulated space, generation side, we are expecting NTPC will do better in FY19. In the transmission space, we still believe that the power grid will continue to deliver good earnings on the back of higher capitalization. So there we are expecting close to 30% kind of potential upside from the current levels. Our target price is 256 rupees. And in the private space, we have some positive view. I mean, not hold recommendation on CESC and the Tata Power at this valuation, while we maintain our negative view on the Adani Power and JSW Energy.
Okay, Rupesh, we leave it at that. Thanks a lot for joining us and giving us on the entire sector. Of course, as Rupesh has already mentioned, he is positive on NTPC and he's going to watch out for more developments from the rest of the sector as well. But, let's address two listings today, and one of them was Sandhar Technologies, the other one was Karda Construction. Let's take a look at what each of these, IPOs are doing right now, the ones which are listed today. So Sandhar Technologies is up as much as 3.4%, and it's had a reasonably okay listing. Karda Construction, on the other hand, has seen some amount of weakness coming in. It's declined by as much as 22%. So moving on and addressing Sandhar, it's come in the issue price at around it's raised about 512 crores. This is the initial public offering, and subscribed as much as 6 times, a little over on the final day of bidding day. We have Ridhima Saxena, who caught up with the co-chairman and managing director Jayant Davar to discuss the company's growth outlook and also how they plan to deploy the IPO funds. Here's a slide of that conversation. Listen in.
We have 79 OEMs. We have 40 plants by the end of the year. We have 29 product categories leading up to thousands of components that we manufacture now. Today, 5 of our plants give us about 65% of the, 5 of our clients give us 65% of the revenue. But like I said, there are 79 who are in the pipeline. And each of them to mature, that's the future and process that we're looking at. We are very, very well diversified, not only in terms of product lines, but in terms of geographies, in terms of the automotive sectors, in terms of whether it's 2-wheelers or 3-wheelers or 4-wheelers or tractors or construction equipment or off-highway, what have you. So to us, at this point of time when the economy is doing well, especially in the auto sector, we have all our guns firing, and I see no reason why there should be any kind of a dilution of growth as we go forward.
So you had indicated in your expansion plans that you would be commissioning 5 new plants in India. Help us understand where that process stands right now, and how much of investment would be debt financed versus internal accruals for these expansion plans?
Well, one of the core reasons for us to go for this listing or the public issue was to retire the debt that we had on our books. We had about 500 crores of debt, out of which 250 crores is working capitals, and that also largely for our overseas operations where the cost of funding is much lower. But the term lending, which was about 250 crores, will be wiped out completely. We will work on a clean slate, and we have a caveat within ourselves that for the next few years, our investments will not exceed our level of depreciation. So a large part of the investment has already been plugged into the new plants that we are talking about. At the time of filing of our DRHP, we had 8 plants that were to go under commissioning. 3 of them have already been commissioned and have started operations. 5 are in the pipeline, which should be up and running before the end of the year. That's the plan.
So how much of the investment has already gone in? What will be the capex that will be required?
We have already spent over close to 650, a little over that crores. The incremental one is very, very small. But like I said, I've given you a caveat and a qualification that in the next few years, we don't see that exceeding our level of depreciation, which is at about 60-65 crores a year.
Correct. So your debt to equity comes to 0.4 after this listing. So going forward, would you be able to maintain that ratio, considering there are major expansion plans happening? And also adding to that question, going forward, what would then be the focus areas, since you're already very much present in 2-wheeler locks and rear view mirrors?
Yeah. Well, a large part of our investments, which have yet to build revenue, are in the new areas that come out of government mandates, whether it's emission norms, where we are doing our fuel pumps, new air filters, oil filters. So that's one portion of it. The other portion of it goes into our foray into auto electronics in a large sector. So we're looking at rear parking sensors, we're looking at tire pressure monitors, we're looking at avian assemblies that we've just started. Those are areas which we believe are the futuristic areas, and we are pursuing that. So besides doing what we are already doing, where we are obviously, where again we are growing higher than the rate of the industry on account of new innovations that we are bringing into our existing products, we see that to be one area, and the new investments in the new areas that I spoke about, bringing in a separate stream of growth, which will obviously mean that the company as a whole would be able to move much faster.
On debt to equity?
On debt to equity, we are at 0.4. Like I said, the term loan debt is going to be cleaned out completely. With that happening, we'll only basically be looking to have a working capital. In India, our working capital cycle is actually negative. It's only our overseas operations that require working capital. And there again, at lower rates of interest from the international markets, which is serviced from there, we expect that our debt equity ratios will be very, very comfortable.
All right, so that was the management of Sandhar Technologies, trading about 3% higher right now. But another stock which is in spotlight right now is Filatex India. Now, the stock is trading with gains of over 4% in trade today, in addition to gains of about 5% that it had seen in the last week itself. The company recently commissioned commercial production at its Dahej unit. Let's discuss this and the company's expansion in further detail with the chairman and managing director, Madhu Bhageria. Good morning, Mr. Bhageria, and if you could throw some color on India's current cost competitiveness with China in polyester yarns and how exports are doing for the industry at large.
Good morning. See, last year textile fibers for the first time has crossed 100 million tons, and the main in that is synthetic fiber, which are around 63%. Out of that, polyester would be roughly 54 million tons. That is 54% of the total global scenario. And India is now getting very competitive against China also in polyester. The main reason is the cost of labor in China has gone up tremendously. As compared to India, the cost of labor in China is roughly 3 times. And also in the downstream, the use of labor for making fabrics and garment is very high, and the exports of garment of China has reduced more than 15% in last 3 years, and their local demand is also going up. So that leaves us a very good potential for India to export, get the export market.
Okay, sir. So, let's come down and talk a little about your company as well. We'd like to know a little more about whether or not the trial runs for the new capex have been done, and if you could also tell us a little more about, capex that's been planned for the subsequent years, and if you could also share some timelines with us.
Yeah, in March we had just commissioned our bright polymerization capacity of 108,000 tons, which consists of fully drawn yarns of 69,000 tons, partially oriented yarns of 9,000 tons, and chips of roughly 30,000 tons. Out of this 30,000 tons of chips, 13,000 we will be using captive in our Dadra plant. So we had started trials end of Jan. Now from 7th of March we have come into commercial production. The full utilization of this will be achieved in next 3 to 4 months. Overall capacity of all the plants together now stands at roughly 330,000 tons, with a range of all POY, FDY, draw textured yarns in all semi-dull, bright and colors. And this expansion we had to spend around 343 crores.
What is the kind of incremental annual
Going forward,
EBITDA?
we have plans to use.
Right, so go ahead.
EBIT we will get, EBIT from this new incremental capacity, I think we'll get around approximately 90 to 100 crores.
All right, and so what is the current
going forward, we
debt?
have plans to have another capex in. See, March 18, our debt would be close to 600 to 625, including working capital.
Okay, so sir, before we let you go, we just a final word on your debt structure right now. Where does it stand, and do you expect to see a change in your debt mix going forward?
Yeah, because we have just completed our this brownfield project, so that debt is little higher. But in FY19, we will consolidate. We will be paying more than 100, reducing it by more than 100 crores. And we don't have any major plans for any expansion in FY19. FY20, we do have some plans. So I think by FY20, we should be in the debt of to equity almost 1:1.
Mr. Bhageria, thank you very much for joining us and wish you all the very best for the quarters going ahead. That was the management of Filatex India. But let's shift focus to Indian gas producers who will earn more for every unit that they sell, at least for the next 6 months. The government has hired or hiked administered gas prices for the first half of the new financial year, taking it above $3 per unit for the first time in as much as 18 months. Somit Sarkar is here to tell us which companies stand to gain the most from this hike, Somit.
So they have set the gas prices at around 3.06 per million British thermal unit, that is MMBTU. And if you see, this is the hike of around 6% compared to the last 6 months. Now, if you see, this is the second consecutive hike that has come in, and this will be beneficial for the gas producers because this revision in hike, along with the government's focus to double the gas output, will definitely lift the gas business of a few gas producers like ONGC, Oil India. Get the next plate. Also, they have raised the gas prices for difficult fields by around 8% to 6.78 per million British thermal unit. Now, this revision will boost the gas businesses of these companies, and it will be most beneficial for ONGC and Oil India, because if you see, they produce nearly 80% of the gas produced in India. ONGC produces around 72%, while Oil India produces 9%, while the remaining 19% is produced by the other private players.
Is there any way of calculating how much gas producers stand to gain from this hike, Somit?
Now, if you see, the gas business contributes nearly 16 to 18% to the top line of ONGC and 15 to 17% to the top line of Oil India. While on the EBITDA front, it contributes 14 to 18% to ONGC, while 14 to 17% to Oil India. So we have tried to see what can be the EPS impact by by applying the same this new rate of $3.06 per MMBTU to the corresponding period last year, that is the first half of financial year 2018. So we are assuming that the sales and the production number are same. And as the production number is same, the cost of production will also remain same. We are also assuming that the company pays taxes at the same rate. And lastly, we are assuming that the rupee to dollar conversion rate is close to 65. So if the gas was sold at $3.06 per MMBTU, then the gas revenue for ONGC would have been close to 6,900 crore rupees, while for Oil India it would have been close to 881 crore rupees. This would have translated into an incremental profit before tax of close to 1,300 crore rupees for ONGC and 167 crore rupees for Oil India. And after paying taxes, that would have come to an EPS per share of around 0.7 for ONGC and 1.6 rupees for Oil India. That means that EPS would have been boosted by 10% for ONGC and 11% for Oil India if the gas prices would have been at $3.06 per MMBTU for the first half of financial year 2018.
All right, so thank you very much for bringing us all those details, Somit. ONGC and Oil India stand to gain the most is what research throws up. And of course, you also have Reliance Industries and HOEC, apart from those two names which are reacting positively to that development on the gas price hike, which has been in the offing for a while. But with that, it's a wrap on this edition of Trend Spotting. Up next is Hot Money. Stay tuned to Bloomberg World.